Hey there, Canadian wealth secret seekers. It's Kyle here for another weekly Secret Sauce episode. And today we're going to be taking a look at the passive income tax problem for our incorporated business owners. Now, what inspired this particular episode was a recent conversation I had with a client who earns quite a bit of active income inside the corporation. And I have this conversation quite a bit, so I thought it would be helpful for you to hear a little bit about this. If you're watching on YouTube, I'll have some visuals here so you can actually watch and follow along. If you're listening, of course, if it sparks an interest for you, please head on over to YouTube and you can have a peek at some of the visuals that go along with this discussion. So first off, let's talk about the actual situation here. We have an incorporated business owner. This particular business owner is from Ontario, so we're going to make some Ontario assumptions. However, across Canada, you're going to be dealing with very similar situations. Of course, the numbers are going to be slightly different, but not by much or not enough to make it substantial or different enough to affect your situation. For all business owners who are earning active income inside the corporation, you are left with an annual decision to make as to whether you should keep any additional income inside of the corporation or the corporate structure, whether you should send it to yourself via salary or a dividend, or maybe if you should send it off to, say, a holding company in order to reinvest. So as we're going to explore here, we're going to talk specifically about a particular business owner who has quite a bit of retained earnings that over time is still inside the corporation. So it's stuck inside the corporation. And this particular individual has been investing in fairly conservative assets that produce passive income. All right. Now, passive income or investment income is taxed at a very high rate, pretty much everywhere in Canada. But here in Ontario, it's just over 50%. And the lowest, I believe, is somewhere around 46% for those in Alberta, but very, very high tax rate. So that means if, say, I was receiving a 5% rate of return, I'm basically chopping that in half. I'm really getting 2.5%. And that's actually what this particular individual was dealing with. Now, before I go further, I want to make sure that everything we discuss here is for entertainment and educational uses only, and that you should seek out financial advice. All right. So this is not for financial advice. These are ideas and things that you want to bring to your financial advisor or those on your team who help you with this type of tax, legal, and investment advice. All right, so let's dig in here. With this particular business owner, I had asked about how much did they have invested and earning passive income and what was the rate. And for this particular individual, they were earning about 5% on. It was actually over this amount, but I'm going to use 10 million as the exemplar here so that you can scale up and down based on your situation. You can get a better sense of what that might look like and sound like for you. So we're going to use 10 million as this amount of retained earnings that over time had already paid corporate active income tax on. And then they had invested into investment income generating investments, right? So they're earning around 5%, they had said, which really after taxes turns into something more like 2.5%. So that's really important for us to consider here. So each and every year when that income comes in, they're giving half away in passive income taxes. Now, an aside is that over time, as you continue to grow this income inside the corporation, eventually when the shareholder takes some money out, there will be a tax credit to the corporation. So the corporation will receive some of that income tax money back, but then you're going to be personally paying tax on the outside. So we're not going to consider that nuance right here. We're just going to talk about what we could do in order to try to reduce the passive income tax that's being generated each year. Because of course, if I'm earning 5% and then I'm being taxed, so it's more like 2.5%, I'm really going to be compounding this at a at a rate of interest of about 2.5%, not at 5% as we might think. All right, so this is really important. So on $10 million, this particular individual who is earning 5% or 2.5% after paying the passive income tax each and every year, they are going to have essentially $250,000 going to tax and about $250,000 that they can then reinvest, right, into whether it's dividend stocks, whether it's into interest-bearing accounts, whatever it is that they're doing that is generating them this 5% return. All right, now, this is obviously a problem. Now, something that is easy to forget is that the initial $10 million that we're going to be talking about here, we are assuming this $10 million was earned as active income inside the corporation. So what that means is this money has already paid active income tax. So some of that money may have been at the low rate or the small business tax credit rate here in Ontario, currently at 12.2%. Anything above the first $500,000 per year would be at 26.5%. So somewhere between those two numbers has already been paid, and they've now retained this $10 million in order to put it out into the market and earn passive income off of it, or investment income, which is now being taxed at that 50-ish% mark. All right. So this is a problem because that 10 million still has to be taxed at a personal level for the shareholder or some future shareholder of this corporation. All right. So we can see on the screen for those who are hanging out with me on YouTube, you'll notice here that 10 million each year, we're going to earn $500,000 or $500,000 in income on this particular investment. But half of it is going to go away in taxes. All right. So we can see that clearly on the screen. So it's more like earning about 2.5%. So the question then becomes, what do we do? Because we still have, $10 million that eventually, if I want to personally use this, if I take it out as a salary or dividend, I'm going to be paying high personal taxes, right? If I took 10 million out all at once as a dividend, you're going to be losing around 40-ish%. If you take it out as a salary, it's even worse. You might do something in between, a little bit of this, a little bit of that. And of course, if you did it very slowly over a long period of time, we can maybe get those rates down a little bit because we'd be manipulating our personal tax bracket for each and every year. But really, if we have that 10 million, we do want to take it out, we're going to be losing quite a bit in personal taxation. So this is why a lot of people will leave money in the corporation in order to start earning some income, and oftentimes in a conservative type of investment. But then the upside is getting halved, right? So, I mean, it's just the reality of it. The government's suggesting to you, hey, maybe you want to take some out so we can get more tax now on those retained earnings, and then you can grow it from there. So it's kind of a damned if you do, damned if you don't situation when you're incorporated, right? You get this low active income tax rate. You decide not to take it out because you don't want to get taxed heavily on the personal side. But then anything I earn passively inside the company with that retained earnings is going to essentially half of it's going to get gifted to the government each and every year. So that's a problem. So retained earnings are going to be stuck. Plus the money that we're earning on those retained earnings each year. So that 2.5-ish% that we keep still needs to come out of the company at some point in the future if I want to personally use it as a shareholder. So we've got a bit of an issue here, a bit of a challenge. So what can we do in order to try to figure this problem out? Well, for those who have been hanging out with me for quite some time on the podcast, you're going to know that I often try to expose insurance strategies that can help specifically investors and incorporated business owners. So this particular scenario, we're going to introduce the idea of permanent insurance in order to do this work. And what you're going to notice here, I ran on this particular individual, I picked 50 years old as an age. So somewhere in the middle of their, working life as they're building this business. This still works for older shareholders. It works for younger shareholders, okay? But I just picked 50 as a number. That gives us a nice runway here to work with and some comparisons. And what you're going to notice that if we look at a 10-year comparison, for those who are aware, a permanent life insurance policy that we're going to use, we're going to look at permanent whole life insurance here. So we're talking about a participating whole life insurance policy that's going to be designed to have a early high cash value. We're going to do this very, very strategically so that there is some opportunity. We're not going to just buy a lot of death benefit and help the next generation. That's not the point. Here, we're going to try to figure out how do we do a conservative investment inside the corporation better so that we don't have to gift so much in tax. And in this case, we're going to see we don't have to gift any of it in tax, and we're going to get some other bonuses along the way. So what you're going to see on the screen, and those who are listening, we're going to look at after 10 years, a comparison. If instead, I know it was $10 million that they have in there, but what we're going to look at today is, let's say if we just went $1 million per year for 10 years to get that $10 million into a particular policy. So we're going to keep it super simple, super basic, and we can do it even better than this scenario if the person wants to get more money in earlier. This is just going to show a very basic, plain Jane approach over time. It's almost like if we could pull a share and if we could turn back time and do this all over, instead of that, passive income investment being so high, what we would do is over time, as we're retaining earnings, we would slowly fund a policy instead. What you're going to see after 10 years of, instead of putting $1 million into this passive income generating investment that's going to be taxed at 50-ish%. After 10 years, if we do that, you're going to end up with $11.5 million after accounting for the taxes and just continuing to compound that investment. So over 10 years, we now have $10 million of retained earnings in that investment, and it's grown to 11.5 million. So you can see it split up on the screen here. We've got 10 million of retained earnings and then a growth of $1.5 million. Now on the right of my screen, you're going to see the same 10 million, except this time we're looking at taking the 10 million and instead of each and every year putting 10 million into the same investment generating 5% per year, we're going to put it into a well-designed permanent life insurance policy. Now, I ran a scenario from a very reputable Canadian company. I won't tell you the company just because I don't want to get in any trouble here or, make it seem like I'm a fan of this one and not that one. But I took a very, very, very well-known company, and we designed this policy to take $1 million each year for 10 years, and then we offset the policy after year 10, just so we could just deal with this 10 million. The results would be better if we did it longer, as you can probably assume here. But let's have a look at what happens. And you'll notice after 10 years, we've done the same thing. Instead of putting it into this passive income generating investment that was earning 5% of before tax return, and now it's 2.5% after tax, you'll see the permanent insurance has now a cash value of 12 million. So we are ahead by about $500,000 after 10 years. Now, in the first couple of years, okay, this passive investment is going to look better because in the first couple of years in a permanent insurance policy, the cash values are hindered a little bit. We call it a bit of a sunk cost or a startup cost, okay? We could look in that in detail. If anyone's listening and they want their scenario run, they can reach out at CanadianWealthSecrets.com/discovery, and I'll run you a scenario and we'll go through each and every year so you can see how this grows. But we're going to look at a 10-year comparison here. So already we could see after 10 years, we're in a much better place. But something that I want to share with you is what else you're getting here. So once again, over in the passive investment side of things, you're going to notice that we still have to eventually, if we want to personally use this money, we've got to deal with the 10 million in retained earnings. Now, in the insurance world, we don't want to withdraw this money and cancel the policy. We would always look to a leverage strategy. So we could easily leverage this money inside the company, or we can look at more advanced strategies and using personal leverage against either these assets or some other assets in your portfolio in order to be in a much better situation. So we're not canceling a policy and we aren't actually attracting additional personal taxes along the way. Okay, so we're not going to dig into those nuances here. We're just going to look at a direct comparison at these two, and I'm going to call it an investment in this case, even though, again, 5% isn't exactly my return that I'm looking for when I'm putting money into an investment. However, this particular individual is, and that's what they have. So we're going to look at it as an investment today and actually a much better approach to deal with this situation. Now, something we don't get on the investment side versus on the insurance side is this death benefit. So if you see up on the screen, you'll notice that we actually have a death benefit of, so a cash value of $12 million that we can leverage against and utilize for asset purchases or anything like that. But you also have a $32 million death benefit. So if I was to pass away at year 10, there would be a $32 million death benefit. So the cash value is no longer a thing. The cash value is only there while we are alive and well. It's basically giving you a living benefit that you can utilize while you're alive to leverage, to use for reinvestment, for income, whatever you choose, it's totally up to you. But this death benefit, as soon as I pass, I'm now going to receive a $32 million windfall. Now, because this is going to be held inside the company, it's the company that is going to be the beneficiary. So some people are thinking, well, now I got $32 million in the company. It was tax-free to the company, but how the heck am I going to get this thing out? Like, how do I get $32 million out? Don't I have a bigger retained earnings issue now? The answer is actually no, you don't, because there's this thing called the capital dividend account. And the capital dividend account is actually a notional account that is essentially tracked anytime you have a capital gain. Any of the tax exempt portion or the tax-free portion of a capital gain, now for corporations, 1/3 of your capital gain is tax-free. That goes as a credit to the capital dividend account. Well, with insurance, at year 10 on this specific illustration that was run on a 50-year-old male, non-smoker, healthy individual that funded for $1 million each year based on the current dividend rate of a participating whole life policy with that company, they would have a $23 million tax credit, a capital dividend account credit. So if they passed away, they're going to be able to, and not them, unfortunately, they're not going to be with us anymore, but their estate is going to, or the next shareholder, I should say, is going to be able to take out $23 million tax-free as a tax-free dividend because of this CDA credit or this capital dividend account credit. So if you look on the screen, everything is proportional. You know, I used to be a high school math teacher, so you understand I'm very, very important. You know, I make sure that these are all to scale. You can see here the comparison that the capital dividend account credit is not as big as the death benefit yet. You'll see this, what I mean by this later, but it's much larger than the $12 million that was cash value the day before I passed away. And it's obviously much bigger than the $11.5 million of total passive investments if you didn't use the insurance strategy here. So you are actually getting yourself to not only solve your retained earnings issues that we had at the beginning, but you're actually freeing up an opportunity to take out even more of that death benefit tax-free, or at least the shareholders who now own this company, whether it be a spouse, whether it be, kids, whether it's gifted to a charity, whatever it is that you choose, that money will be able to come out tax-free. So that's pretty impressive. Now, It gets better. So as, I almost feel like it's a bit of an infomercial here because, it's like, just wait, it gets better. And it really does, which is why we specifically work with these types of strategies with incorporated business owners. These CDA account credits, these capital dividend account credits that a death benefit can produce is a compliant legal way for us to deal with retained earnings, but also with the cash value, giving us the opportunity to leverage that value while we are here and alive using some pretty sophisticated strategies that we can work with you on if interested. So let's zoom out a little bit. Okay, we're at 10 years. We're seeing there's benefit. Let's look at 20 years now. So for those who are hanging out with us on the screen, you're going to see that if we left it in the passive investments earning 5% per year, we're getting taxed, as we already know, we're about half of the money in taxes going away. That means these passive investments have grown to $14.7 million. Still nice. It's not bad. But remember, I still need to deal with the taxation to get the 10 million retained earnings out when I want to use this money personally. I still have to deal with the tax on the personal side that's associated with the $4.7 million that has grown over time. Whereas if we look at the insurance strategy, you're going to see up on the screen that the cash value alone, without even considering death benefit and the CDA and all of that stuff, the cash value has grown to 18.7 million. Okay, so passive investments are at about 14.7 million. And the cash value of this insurance policy that we built for this particular individual, this particular scenario, is $18.7 million. Same 10 million, same contribution schedule, right? And when I say contribution, one would be premium, which is the insurance strategy. The other would be investing the extra million per year, every year for 10 years into that passive income generating investment. And you are now almost double the quote unquote profit or growth of that earning potential. All right, so you can see that now the death benefit has grown as well. It's grown to 33.9 million, not dramatically, not as dramatically as the cash value's grown, but you're also going to notice that the capital dividend account credit is also growing. So essentially, the longer we hold a policy and I would say the closer to the average age of life for Canadians, the more of the death benefit will be completely tax-free. Now, this is for a number of reasons where we won't get into the nuances here, but essentially, we're able to quote unquote expense the cost of insurance in the background. So this is already done for us on behalf of the insurance company. So I've got $18.7 million of cash value there that I can leverage against and utilize inside the company, reinvest. I can use other leverage strategies on a personal side because remember, you own the shares of this company. So you have quite a bit in assets. You know that the company's value is worth at least $18.7 million unless you have all these other debts inside the company, right? But let's assume it's the only asset in there. You know that that's worth at least $18.7 million, right, of cash value. So that's really important to consider. Now, if we keep going, let's look at a 30-year comparison. So now this 50-year-old's now 80. Okay, so when we get to 80, things get even more dramatic. The passive investment route would get you to $18.8 million, whereas the insurance strategy gets you to $28.8 million, which is obviously a dramatic improvement or a dramatic difference, right? $10 million ahead of where those passive investments would be had we just sit there and let them roll at 5% per year, paying all of that passive income tax. But remember, the death benefit's also growing. We're at $39.7 million. And look at the capital dividend account credit. The CDA credit is $37.2 million. So I've put $10 million over the first 10 years of this insurance policy. The death benefit's grown to $39.7 million and $37.2 million. So essentially almost about $2 million is sort of quote unquote stuck inside the corporation as having to be taxed on the way out. Remember, that 10 million with that passive investment still would need to be taxed had it not touched an insurance policy. And I'm just for good measure going to show you once this individual reaches age 90, then you'll notice the CDA credit, 50.2 million, is equivalent to the death benefit of $50.2 million. So that amount can be withdrawn from the next shareholders of the company tax-free without paying any personal taxes. The day before this particular individual was to pass, the cash value looks to be at about $43 million in comparison to the passive investment route, which would have it at $24 million. So, what can we learn from this particular situation? Well, what I can tell you is that when we look at passive income inside of a corporation, insurance strategies are, in my opinion, essential. Now, I'm not suggesting if you have some great investments that are returning 15% or 12% or even 9 or 8% routinely that you're necessarily going to dump all those investments and put it all into insurance. But what we should be considering, and this is the secret sauce for today's episode, at minimum, retained earnings should at best, hit a policy first before leveraging those policies to create more assets. And of course, it's going to in turn create a bigger tax problem. Because as you saw in these examples, in this particular scenario, in this particular episode, you're going to solve your tax problems through the use of insurance over the short and long term, while not holding all of your retained earnings hostage either, because we can leverage the high early cash value for asset purchases or for other means, including considering for income strategies. So, friends, if you found this to be a helpful episode, whether you are incorporated or not, and you found maybe some of the tips, the tricks, the ideas that we're sharing here useful, do us a huge favor, hit subscribe or follow on whatever platform you're on, and leave us a rating and review on Apple Podcasts. As always, you can reach out to myself through CanadianWealthSecrets.com/discovery to hop onto a discovery call, whether it means dealing with your own passive income generating issues or tax problems, or whether you have other ideas and you need the next step in your wealth building journey. Reach out. CanadianWealthSecrets.com/discovery. And I look forward to having a great conversation with you real soon. Take care.